Hey friends, it is Brooke from LegaSHE. Before we get started today, I want to say thank you all for the love. It's been amazing the last 3 days. Can you please do me a favor? I would love this if you would do me the honor of clicking the button. There's a button somewhere, there's a little logo, and then there's a button when you hover over the logo and it allows you to subscribe. If you subscribe, and then down in the comments, write, I have subscribed. I am going to do my best to respond to a bunch of you. It'd be an honor. It would be my privilege for you to continue to follow along on this journey of building LegaSHE and talking all about commercial real estate. Thank you. Hit that button. Okay, and now we go serious mode. I'm going to talk today about the three things that you really need to understand for commercial real estate. It's just three. I told you I like to simplify everything. I'm going to start with the three things, and then I'll drill into some nits and gnats on each of the three. Number one, net operating income. What is that? Number two, how to value a building. Number three, some ratios or metrics. That's it. That's commercial real estate. Go home. I'm kidding. It is very good. There are aspects of commercial real estate that are very challenging, but the basics, the fundamentals of commercial real estate, quite straightforward. So let's dig in. Bullet one, net operating income. Net operating income is simply, my theme of simplifying everything, simply revenues less operating expenses. That's it. But what's the revenue of a building? The revenue of a building is its rents, its lease obligations that the tenants are paying to the landlord. So rents or lease revenue, that's your revenue. That's your gross income. That's your revenue for the property. Operating expenses. Well, I run a building. I have to pay utilities. I have to pay for management of the building, cleaning of the building, maintenance of the building. That's it, right? So you are basically looking at how much are my tenants paying me, and then how much do I have to pay to operate this building in an appropriate manner. Little trick, LoopNet. LoopNet.com. LoopNet is a fabulous place. These websites didn't exist when I first started. I had to pick up the phone and I had to call around to get lots of comparable rents, comparable revenue, and comparable expense data. Now you can go on LoopNet and you can find for yourself there broker packages. Someone's trying to sell a building and their broker has prepared, or they, the owner, has prepared for themselves information that they're going to put out there so someone can assess the net operating income of their building. Well, it's really good education for you. I'm not going to replicate that education. That's the best education. Go and pull down some financials from different buildings and see what the operating expense lines are and see the differences between different buildings in different areas. And it's a great exercise if you're learning commercial real estate to visit LoopNet, and you all are very blessed. You can now have that data at your fingertips. I am so happy that the data is now at our fingertips. Take everything you read on the internet with a grain of salt. Everything that you source from, anything I say, you best be taking with a grain of salt, right? You always should take everything with a grain of salt, because especially in the LoopNet space, the broker or the owner's job is to sell their property, so they're likely going to make it look rosier, portray it in the best light and not necessarily tell you every detail. That's just the way it goes. We accept that. And so therefore, when you're looking at information, you're looking at data, just take the data with a grain of salt. If it doesn't make sense, ask yourself why. So that's your NOI, net operating income. And now, really importantly, NOI, there's a difference between the in-place NOI, as in the building is up and running and has tenants in it with leases, and it is producing net operating income. It's producing income. And pro forma NOI, I have a piece of land. I'm trying to value this land, trying to sell this land, and there's no building there. There's just expenses. Maybe there's some expenses for taxes, utility, whatever. There's some expenses for the building or for the land. There's no building there. So how do I value that? Well, pro forma NOI is what type of income can I generate from this property after I've done something to it. So the in-place NOI might be 0 or negative. But the pro forma NOI is the result of you using some capital to do something to that land, build a building on it, or lease the land out as a solar farm, make a parking lot there. There's lots of ways to generate revenue, pro forma, to create your pro forma net operating income. So you really need to understand that net operating income is both the in-place as well as any future pro forma look at what an NOI should be for the property once you've developed it, redeveloped it, or repositioned it. Bullet 2, valuation. So how do I value a building? How do we do that? How do we value a commercial real estate building? In residential real estate, it's done with comps. That house sold for that price, and it had this many square foot, and it had these types of improvements. So therefore, my house, which has a lot of those similarities, and maybe I make some adjustments based on their kitchen was nicer than my kitchen, whatever, right? I make some adjustments. I do valuations via comps. Well, commercial real estate is very similar, except commercial real estate has net operating income, our cornerstone, our foundation. So if I have a net operating income for a building, I can actually create a valuation model as based on some of that comparable work and something that we call a capitalization rate. So what is a capitalization rate? Super simple. Remember, the goal of life is for us to be really simple. Let's boil this down. Capitalization rate is your net operating income divided by the valuation of the building. So I have a net operating income. Here's how much cash I generate, or how much profit. Net operating income, how much profit I'm generating from this property before I pay any capital charges. And then I have a valuation on the building. NOI divided by the valuation gives me a capitalization rate. That's simple. I did not go through the whole math behind it. I didn't go through the economics of it. I'm not overcomplicating it. I'm just saying that's the simple way to think about a capitalization rate. So if I have a building with a certain NOI, and I look around my location, my neighborhood, and I find, just like in residential buildings, other properties that are relatively similar to my property. Well, those buildings, if they have sold recently, they're going to have something called a capitalization rate because they had their own NOI and then they had a value that the market was willing to pay. And the value the market was willing to pay is based on a lot of factors, right? It's based on the location. It's based on the amenities. It's based on the finishes. Do they have nice kitchens in those units or not? I'm using that as a simple example. It's based on interest rates at that time. It's based on the market dynamic. So that property that you're looking at that's similar to your property in your neighborhood is going to have a cap rate. And you can take your NOI and divide it by a cap rate for a building that's very comparable to yours and yield what you believe the value is if you were to try to sell that property in the open market. So the valuation of a property is typically the NOI divided by the cap rate. It's very, very simple, straightforward math. But what about a building that has no cash flow? What about if all the tenants are gone? Or what if the existing owner of the property isn't maximizing their revenue for the property for some reason? Whatever the reason is. We don't judge here. We're doing the logic. No judgment, just the logic. So if the building's in-place NOI isn't yielding you the proper valuation, you remember I spoke about pro forma NOI? You're going to look at some pro forma numbers on the property and say, well, what if it's land and then you build a building on it? Well, if it's land and I build a building on it, it's going to look very different 3 years from now. So I should be using some pro forma NOI numbers and a very thoughtful analysis of where I think capitalization rates should be for that property 3 years from now. I take that pro forma NOI divided by the pro forma cap rate, and I get what I believe the valuation of the building will be in the next couple of years. So CRE investors, CRE owners, CRE experts, CRE financiers, we all focus on net operating income over a period of time, maybe now through 10 years from now or now through 20 years from now, what do we project it to be? And we focus on the valuation over a period of time. Those are two essential and foundational data points for us in commercial real estate assessments and commercial real estate investing. Bullet 3. One moment. Metrics, ratios, right? So commercial real estate has lots of different ratios and metrics that you can pull into an analysis to say, is this property a good property for me to consider investing in, buying, lending on? And so there are a few really common metrics that you're going to hear. And I'm just going to kind of boil it down to the top ones that you hear banted about. Now, I am more than happy if folks want to add to the comments other metrics or ratios that they think are really important in commercial real estate. But the goal in my life is simplify, simplify, simplify. Yes, there will be plenty of metrics we can all get very encyclopedic with our memory on. But I try very hard to make sure that we simplify, simplify, simplify down to the things that actually really matter in the assessment. So without further ado, I'm assuming many people who are listening to this are familiar with lending on a property. So they're not the owners of the property, but they're lending to the property. And in that space, you're going to often hear two major metrics: debt service coverage ratio and loan to value. And by the way, debt service coverage ratio and loan to value are applicable across different layers of capital. It's just that in the first mortgage and the lending, the call it core first mortgage space, those tend to be the metrics that come up the most. So debt service coverage ratio is, can my NOI, can my net operating income cover the capital payments? Typically it's a first mortgage, but there might be other layers. Can my NOI divided by all of the payments that I need to make to the capital providers, because it's not me, it's OPM, other people's money, can I cover those? So debt service coverage ratio is a really important concept in commercial real estate, and you're going to hear that concept all the time. Loan to value. So that's the loan divided by the value of the property. By the way, it's often LTV. People will say LTV because that's the standard acronym, but loan to value, the concept is applicable to many layers of the cap stack, of the capitalization of a CRE property. You'll hear sometimes people call it, in other contexts, the attachment point. So if you happen to be mezzanine or a preferred equity provider of capital, you may say I have a 90% or 85% attachment point. That means I am giving money to the owner up to 85 or 90% of the total capitalization of the project or total capitalization of the asset. So loan to value is another concept that will come up often. There are other metrics based on where you are in the capital stack that you'll hear about. You'll hear things like the equity multiple. If you're an investor and you're in the equity, you'll hear things like IRR, internal rate of return. What's the return that I should be earning if I am in the pref or I'm in the common equity? I'm the equity owner or in the equity capital. So you're going to hear these different ratios, different metrics. That's bucket 3. And what's key in that bucket is just knowing where you are in the capital stack and which ones are relevant. And that comes, again, through looking at different things, asking lots of questions. I was in the debt space. I was in the lending space for the earliest part of my career. And so therefore I leaned heavily into the debt and lending metrics. And then I had to learn new things when I moved into the private equity and the equity side to really round out my understanding of ratios. But it's nothing to be embarrassed about. And now I'm speaking directly at folks who do get nervous at times where there's a lot of acronyms being used, where people are demonstrating their intelligence by using lots of very specific industry terminology. Be an intern of life. Ask questions. No one was born knowing commercial real estate terminology. They learned it along the way. And actually, I'd like you to look at people who try to wield the terminology as if they are smarter than others and say, simmer down. I need you to explain this to me. You're intelligent. You can do this. Ask the question. Don't be shy. Thank you, everyone, for listening. LegaSHE. Follow me here. There's a button somewhere there. Please follow and comment. Cheers. Bye.